Let's get Q4 started. Live from New York City this morning. Good morning, good morning. Your equity market just a touch softer here. On the S&P, we're down by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, waving good riddance to the worst quarter of the year. Congress just about avoiding a government shutdown, allowing us to look ahead to the payrolls report. We begin with the big issue. Hello, Q4.
As we look to fourth quarter.
The fourth quarter's got these weird things.
Financial headwinds continue to mount.
Everything from oil prices rising,
student loans restarting,
rates still remaining elevated.
They are going to hurt consumption.
Consumer could come under pressure.
It seems very, very hard to talk about positive economic activity in the fourth quarter.
Last quarter was very difficult.
The third one was quite stormy.
The market is likely on better footing.
You should be starting to see an inflection point in earnings after 3 quarters of negative earnings growth.
We could very well be set up for a good fourth quarter.
We're circling this earnings season as a critical one.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Joining us now to discuss is JP Morgan's Jack Manley, Seema Shah of Principal Asset Management. Seema, first to you, what is there to like about this stock market in the fourth quarter?
Hey, John. Well, look, there are a lot of headwinds. We've already heard that from the people just now. Energy prices. You have, of course, the sell-off in bonds as well. But at the same time, the thing that we have to like about the economy is just it continues to be so resilient. You know, the economic data keeps pouring in. It still shows a solid economy. So I do think that there is weakness ahead, but I'm not convinced that Q4 is going to be the time that you start to realize some of that weakness that we're anticipating.
Let's talk about that recipe for weakness. Jack Manley, you know the names. Energy prices. This is the blame game. Energy, higher rates, student loan payments resuming. Do you see a real test for the consumer building here into year end?
I am concerned a little bit, John, frankly, especially because the fourth quarter is such an important shopping season, right? We know that this is when the consumer really goes all out heading into Thanksgiving, the December holidays. This is when we like to spend, and we are facing down a very significant wall of worry with all those things that you just mentioned and maybe a few others, too. So I do think that there is some risk to the consumer as we move into this critical shopping season. That means that there is a little bit more of a risk to the economy than I would have expected even a couple of months ago.
Discretionary stocks got hammered in the last couple of weeks, Seema. I just wonder how much of that test this market has already discounted.
I think it's, the consumer, I think everyone is familiar with that story. And, I don't disagree with anything that Jack has said. I just think it's moved out until Q1 now. The discretionary stocks, they are definitely very vulnerable. They're more vulnerable than a number of other sectors. But I think when we start to think about Q3 earnings season, I think generally speaking, it's going to be fairly strong. And that should maybe turn around and maybe give the equity market a little bit of a boost that it's been missing in the last quarter.
Seema, is that the no landing story from earlier this year all over again?
No, I think, so we have to be careful about this no landing. I don't fundamentally believe in a no landing. If you have very strong growth, it ends up in high rates and then you get a hard landing. I think this is more about, about pushing out the date of that recession. And we know we're bored of talking about recession. Economies keep pushing it out. But we have seen that the consumer has really been helped by fiscal policy. And so we're thinking it's moving out into 2024 rather than right upon us in Q4.
Plenty of tests further down the road. Let's talk about a test for Tesla right now. Third quarter deliveries, 435,000, a little north of that number. The estimate, 456,722. That stock is a little softer here. We're down by about 3% on Tesla. We'll talk about that name around the opening bell. For the week ahead, tons of data points, including payrolls on Friday. Lots of Fed speak, including Chairman Powell a little bit later. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. Well, we are not under a government shutdown, so there is going to be a lot of data this week. And as we start quarter four, we're going to start trying to figure out what's going to happen in quarter four and beyond. ISM manufacturing kicks us off today. That'll be important. People will be looking at the prices paid and employment indexes. Jay Powell is making an appearance before small business leaders in York, Pennsylvania. Not sure he's going to say anything in particular, but keep an eye on that. JOLTS, of course, and auto sales on Tuesday. ISM services on Wednesday also look to that employment data. The ADP report comes out in durable goods. As you can see throughout the week, we have a lot of Fed speak. Jobless claims on Thursday. Will that be distorted by the UAW strike? And September jobs, we know that's not going to be distorted by the strike at this point, but it is still going to be an issue. So where do we go from here? Well, Seema was talking about the idea of pushing the recession out. Economists surveyed by Bloomberg, and we put out the latest numbers last week, see the economy just barely skirting a recession in the first quarter, going down to 0.1% for growth, and that is not necessarily something we can, say is missing recession. That's going to feel like recession if that is indeed the case. So what does that mean for the Fed? Well, we had a big turnaround today in the Fed funds futures for November 1st. We had gone down to about 15% likelihood, and now you can see we've bounced right back up since the government is open. The market is starting to think more about a possible other Fed move. We'll get a much better clue by the end of the week when we have all this data.
You said it a million times, Mike. There was a fear we might not have any data at all this week, and now we're going to get it. Mike McKee, thank you. Andrew Holdenhorst of Citi, looking for one more move, potentially November. Looking for this on Friday in the payrolls report, 240,000 new jobs and a drop in the unemployment rate should confirm that growth remains solid, but with upside risk to inflation from tight labour markets. This bond market down again, yields higher. If you're just joining us, here are the scores right now on a 2-year, 10-year and a 30-year. The 2-year still above 5%. The 10-year yield higher by 7 basis points at 4.64. The 30-year higher by 6 basis points to 4.76. And Bank of America published in the last hour, a little bit earlier this morning, saying this: equities can still work in a higher rate environment. The S&P 500 returned 15% year on year from 85 to 2005, with real rates at 3.5%. Jack Manley, how much of a challenge is there from real rates in this bond market to stocks at the moment?
Well, we have to acknowledge, right, that where rates are at the moment is certainly a greater hurdle for equity investing than where they had been just a couple of years ago, right? Stock investors are going to need a little bit more out of the stocks that they're investing in to justify taking that additional risk. But, when I look at the equity market right now, I could absolutely see this market continuing to trudge higher despite that higher rate environment. I think what this points to, though, John, is the need for a quality overlay in portfolios. Money's not free anymore, and I think that even when the Fed does pivot and ultimately move rates lower, it won't be taking those rates back down to zero anytime soon. Businesses are going to have to be a whole lot more thoughtful about how they're allocating capital. Investors, in turn, are going to have to be a whole lot more thoughtful about how they're allocating capital. I'm not trying to make a style bet right now. I'm saying quality, and frankly, I think this is just a heck of an opportunity for active management as well. That's how I stay constructive despite the rate environment.
Jack, what is quality? What would you point to at the moment?
Quality right now, to me, is consistent, dependable earnings, right? Of course, there can be some sort of cyclicality in there. That's always going to happen. Booms and busts in the economy will translate into booms and busts in earnings. But that stability, that dependability, able to generate earnings day one, as opposed to something that may be coming our way 5, 10, 15 years down the line and something more speculative, more growthy. That, to me, is what quality looks like.
Seema, what's your take?
Very similar to what Jack's just said. We're not thinking really about styles. You want to think about pricing power. Inflation is coming down. Even if it were to pick up a little bit, we're not looking at what we saw at the start of this year. So companies are going to be under pressure. So you need to have big names, big balance sheets, things that can deal with this higher rate environment, which seems like it's likely to persist for longer than certainly what we've seen over the last 10 or 15 years.
Do you think this stock market, Seema, can live with 5% interest rates on a 2-year, on a 10-year at 4.64, and with real rates through 2%?
So, look, I think the jury is definitely out on that one. If you're talking about the Jamie Dimon 7%, no, I definitely don't think equities can live with that. I think that something would certainly break. The thing with bonds is it's really the speed of the move up. How disruptive has that been? It has been a very, very significant and sharp rise, and yet equities have digested it. So I almost feel that they have gone over the hurdle. And from here, as long as you're not going to get the Fed moving up significantly further from here, I think as long as growth is there, then equities have got a little bit further to go.
Move in bonds has been phenomenal. Move of more than 70 basis points on the quarter. 4 weeks now. 4 weeks of yields higher on a 10-year, up by about 7 basis points right now at 464. And 4 weeks of equity weakness on the S&P 500. Longest weekly losing streak of the year so far as we kick off Q4. About 20 minutes away from the opening bell. Equity futures here down by about 0.35% on the S&P 500. Jack Manley, Seema Shah are going to stick with us. Let's get you some movers going into the open. Here's Abby.
Well, weighing on futures this morning, John, is certainly what you mentioned earlier with Tesla, with that bit of a delivery miss. The stock right now is down nearly 4%. And this, of course, as their deliveries for the third quarter came in a little bit above 435,000 and well below consensus at 461,000. We'll be digging into that a little bit more on the open. As for NVIDIA, though, we have some strength. And for Coinbase, too, we, of course, have Bitcoin up more than 4%. And in addition, we do have Coinbase winning a Singapore license, so the stock surging there. And then NVIDIA off of its highs, but nonetheless, it was upgraded to a conviction buy from Goldman Sachs. So we do have a little bit of a bounce there for NVIDIA.
Abby, thank you. We'll catch up with you around a cash open in about 20 minutes' time. Coming up, Congress avoiding a shutdown.
Congress passed a spending bill that's going to keep the government open. And it's good news for the American people because the government will not shut down and a needless crisis will have been averted.
Team coverage up next.
Needless crisis will have been averted, saving millions of Americans needless pain. There's no Ukraine funding in this agreement. Despite that, I did not believe we could let millions of Americans go through the pain of a government shutdown. But let's be clear. I hope my friends on the other side keep their word about support for Ukraine.
The United States avoiding a government shutdown, with the Senate passing a last-minute 45-day funding bill just 3 hours before Saturday's midnight deadline. Ukraine aid, a major partisan sticking point, dropped from the final text. Meanwhile, a power struggle playing out in the House as Congressman Matt Gaetz pushes forward with his threat to remove House Speaker Kevin McCarthy.
I do intend to file a motion to vacate against Speaker McCarthy this week. I think we need to rip off the Band-Aid. I think we need to move on with new leadership that can be trustworthy.
I'll survive. You know, this is personal with Matt. Matt voted against the most conservative ability to protect our border, secure our border. He's more interested in securing TV interviews than doing something.
Now it comes down to a handful of moderate Democrats deciding to support McCarthy or withholding their vote. Let's get to the team coverage. Anne-Marie and Katie Lyons down in Washington, D.C. AMH, first to you. Are we doing this all over again on November 17th?
Well, potentially we might, Jonathan. They came to this last minute, really an 11th hour agreement. Everyone, including us in this program, been talking about it. Looked very likely that there would be a government shutdown. But they didn't, and we have until November 17th. It also includes $16 billion with disaster relief, which a lot of people in the likes of New York or Florida or Hawaii are very happy about. Two big things to watch out for. One is that Ukraine aid. That was not included, and President Biden said he hopes McCarthy takes it up quickly. McCarthy, though, yesterday directly linked it to the border. He said the border is my priority. And then the second thing, Jonathan, is, of course, they should be working on those 12 appropriation bills to actually fund the federal government. But a massive headache and distraction is about to hit Capitol Hill this week, and that's when, as Matt Gaetz has vowed, to have a motion to vacate for the speakership.
Kayleigh, can the speaker hold on?
This is the key question, John. Of course, Matt Gaetz has been threatening this for some time. Speaker McCarthy has always had this hanging over his head because in order to get the gavel in the first place, he agreed that any one member could file a motion to vacate. So as Anne-Marie said, Matt Gaetz does plan to do that this week. It's just a question of whether he can actually garner a majority in the House to oust the speaker. It is going to require a number of Republicans to come along with him, assuming that all Democrats would cast a vote to oust McCarthy. And that really is what is not clear at this time. There probably are are enough hardline Republicans who would turn on the speaker. But the Democratic issue is one that really is going to be up to the leader, Hakeem Jeffries. Several Democratic members of Congress, when I spoke with them last week, suggested if McCarthy worked with them in a bipartisan manner, which ultimately he did, to pass the continuing resolution, then maybe Democrats could act to save him by either not showing up to the vote or voting present. But there are also a number of issues Democrats have with McCarthy right now. He yesterday, when speaking on Face the Nation, attempted to blame them for the almost shutdown. He also, of course, has launched the impeachment inquiry into President Biden. Both of those things Democrats take real issue with. So he may have to make some concessions to them, possibly tying it, for example, to the Ukraine aid that Democrats really want. Either way, it's going to be very difficult, very dramatic. And we should keep in mind here, even if McCarthy is ousted, there's not really a likely successor to him at this point, and that would leave some degree of chaos in the House of Representatives.
More chaos down in Washington, D.C. Speaker McCarthy, Anne-Marie, making the point that Congressman Gaetz was more interested in securing interviews. He secured one with you a little bit later on this afternoon. Walk us through what you expect to get from that.
Yeah, that's right. Well, listen, Matt Gaetz definitely wants to try to drum up support for this motion to vacate. The key question is, does he have those votes? As Kayleigh was just pointed to, the hard right flank of his party, will they really want to oust Speaker McCarthy? Because who is the alternative that can get the majority of those votes? And there is a lot of reporting that he's talking to Democrats about seeing if they would sign up to make sure that he's ousted and not potentially leave or vote present. So I think really trying to understand from him where he is on the numbers, that is something that is going to be key for that interview.
AMH, looking forward to the conversation on Balance of Power a little bit later. Anne-Marie and Katie Lyons, thank you. Congressman Gaetz, 5 p.m. Eastern Time, live from Capitol Hill in Washington, D.C. Jack Manley, Seema Shah back with us. Seema, I spoke to Congressman French Hill a little bit early this morning, Republican congressman out of Arkansas, and I asked him whether his colleagues realized that they were losing the privilege to act recklessly when it came to these kind of issues because of what was developing in the bond market. Seema, how much of what is developing in the Treasury market over the last few months or so would you associate with the budget deficit in the United States?
Oh, a significant part. And I actually look at the equity market response and the bond market response. It makes perfect sense. The equity market typically knee-jerk reaction to various events, but it typically peters out. The bond market is looking at the fundamental underlying impact of the fact that the budget deficit continues to grow and at some point needs to be dealt with. So really this higher for longer in central bank rates, but also higher for longer in bond yields is really about that deficit size. I mean, there are a number of other issues, of course, but the deficit, I think, is the one which is going to keep rates probably higher than certainly what we've been seeing in the last 2 decades.
Jack, we know the recipe for the sell-off. Strong data, yield curve control exit over in Japan, QT, rate hikes, take your pick. Jack, I just wonder how much of this has been about Treasury supply.
Well, I think supply is a good portion of it, right, to fund all that debt that we were just talking about. You can talk about some of the fundamentals that exist out there. You can certainly talk about Fed policy and how that's helping to shape at least the short end of the curve. But there is so much supply out there and likely a whole lot more coming our way if indeed we do keep on spending, which it seems very likely that we will. I have a hard time believing that you're going to see meaningful downward pressure on the curve, particularly towards those longer dated securities.
With that in mind, Seema, to that point that Jack's just made, what are the limits to this sell-off, if that's the dominant driver?
Well, look, some of our models are suggesting that a 4.9% handle should not be surprising. So for us, we are not overweight duration at this point. We're expecting a little bit of a leg up, and only do you see the yields start to come down once you see visible signs of economic slowdown, which, as I said before, we're not expecting until early 2024. So for the time being, this is just going a little bit further up.
So Seema, just sit in the front end and let this play out into year end. Is that the ultimate view for you?
I think you need to have exposure at the short end. You know, we have to think about, look, if you're going into a downturn, you do need some kind of downside protection. So we're sitting neutral, we're not underweight, but something neutral means that you can have some exposure without being too exposed to a potential further up move.
Jack Manley, are you on the same page when it comes to that?
You know, there's obviously nothing wrong with being on the short end. There's a whole lot of yield over there with not a whole lot of risk. But I wouldn't say necessarily that I'm going to be underweight on duration. I just like where coupons are at the moment. You do have a really healthy buffer. And I think that if you are taking, a 12, 18, 24-month lookout period as opposed to being a little bit more tactical, you can stomach further upside move in something like the 10-year, given where coupons are right now, understanding that eventually when rates do move lower, likely at some point next year, that duration trade is going to kick in and your total return story is going to be quite attractive. So I am balancing between a short duration and intermediate.
Asima, 3 months might feel like a long time. Just to put some concluding points on the points that you've made over the last 20 minutes or so, that the resilience we see in the economic data could well be with us through year end into early 2024. Now, with that in mind, how challenged do you think, say, valuations might be on tech stocks on the S&P 500, given the developments that you expect between now and year end?
Okay, so I mean, tech stocks are clearly under pressure. They've been under pressure for a couple of months. It's not even just after this this sell-off that we've just seen. They look frothy at the beginning of summer. They continue to look frothy. We continue to own mega cap tech stocks, and the reason is it's not about the valuations today. It's really about what we're expecting to do with AI. So we're not going to add exposure at this point, but I'm not selling because I do believe in the longer term productivity potential a lot of these companies.
So you're thinking more about Nvidia, Microsoft than you are perhaps, say, Apple?
Yeah, I think you want to have greater exposure to AI. I mean, that has to be the long-term theme. The problem with Apple and some of those is the consumer discretionary aspect. You know, you're going into, I agree with Jack, there's going to be a bit of a consumer downturn probably beginning in 2024. So some of those Apple company is going to be under some pressure from a weakening consumer. So you do need to play it fairly wisely. But broadly speaking, that mega cap stock, because of the balance sheet, the pricing power, continues to be one of our favoured areas.
Asima, what do clients say to you when you say this is the quarter for consumer weakness? I've said a few times over the last month or so that it's almost like the economists have cried recession in 2023. Have we got to that point where people have just stopped believing it?
So we are expecting consumer weakness to be shown visibly in Q1, it's not quite in Q4. But actually that narrative is, I think, ringing some bells with a number of clients. They are also looking at the student loans, they're looking at the mortgage payments. You know, we look at the Taylor Swift Beyonce impact, and they know that's fairly much behind us. So actually there is, I think, growing support for this idea that this is going to be a consumer-led downturn. They don't believe it's going to be particularly deep or sharp, but they do believe that a weakness is coming for the economy next year.
Hey, Seema, thank you for the update alongside Jack Manley. Seema Shah there and Jack Manley. To the both of you, thank you. Coming up the morning calls and later, Citi's Stuart Kaiser joins us around the opening bell on whether investors need to buckle up for the road ahead. As we kick off Q4, equity futures slightly negative. We're down 0.2% on the S&P 500. Your opening bell, the cash open, 7 minutes away. Inching towards the opening bell, about 5 minutes away to kick off Q4. Equities just down a touch here on the S&P by about 0.2%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley upgrading US Steel to overweight with a street high price target, naming it as a top pick and highlighting transformational investments. Your second call from Susquehanna upgrading FedEx to positive from neutral, viewing long-term upside opportunity as greater than the near-term cyclical risk. That stock is positive by, let's call it, 1%. And finally, D.A. Davidson upgrading Clorox to buy from neutral, seeing sentiment improving after a crippling cyber attack in the month of August. That stock bouncing by about 1.9%. Coming up on this programme, seatbelt sign on or off. Citi's Stuart Kaiser joins us around the opening bell. That opening bell is about 4 minutes away. Equity futures right now negative by 0.2%. The cash open just around the corner. 22 seconds away from the opening bell this morning. Good morning to you all. Equity futures pulling back just a touch. We're down by 0.2%. Ugly week, ugly month, ugly quarter. Welcome to Q4. Let's see if any of this changes. On the Nasdaq, we're positive by just 0.01%. There's your opening bell, kicking off the fourth quarter. Switch up the board and get to the bond market. Yields higher by 7 basis points. Your 10-year 463.92, coming very, very close in the last week to 470. Let's see if we get closer again this week, going into payrolls on Friday and the ISM a little bit later. Yields up, stocks down, dollar stronger. 105.23 on the euro. We're negative by 0.4% after 11 consecutive weeks of euro weakness and dollar strength. Can we make it week 12? $91 on crude. WTI right now positive by about 0.2%. 0.3%. About 25 seconds into the session, your equity market just a touch softer. We're down by 0.1% on the S&P and a similar move on the Nasdaq as well. One stock to watch at the open, Tesla. The EV maker's Q3 deliveries missing estimates. The stock a little bit softer by 2%. Abby has the story. Morning, Abby.
Good morning, John. And yes, we are looking at a delivery miss for Tesla for the third quarter. The deliveries came in just a little bit above 435,000. The expectation had been for deliveries to come in at 461,000. And this puts into question whether or not Elon Musk's whisper number of about 2 million deliveries on the year, are we going to fall short of that? Now, paired with this news is the Model Y in China, because some of this weakness for Tesla is China. About 22% of the revenues come from China. The Model Y, they are introducing a revamped Model Y in China, and the difference apparently is a faster acceleration, new wheel design, and added ambient lighting. They kept the pricing unchanged, so they're clearly trying to stoke some demand there, at least in terms of volume. Also interesting, John, the stock, of course, up 100% on the year. But if we take a look at the fourth quarter earnings, well, it's expected for a decline. So it's going to be interesting to see how the company talks about that and how investors deal with that if it does, in fact, continue on the year.
A small decline this morning. Abby, thank you. We're down by about 1.7%. Want to stick with EVs. A view on the south side from Evercore, upgrading Rivian to outperform from Inline. The analyst saying this: who is the next Tesla? Rivian has a brand that has stuck the US landing, and most importantly, within segments everyone already wants: SUV, truck and van. Not only has Rivian executed on the production ramp, but the company has also far exceeded our expectations on ramping gross margins. That stock this morning down by, let's call it 0.7%. I want to turn to tech. Microsoft CEO set to take the stand today at Google's antitrust trial. The Justice Department hoping his testimony will help prove Alphabet's search division is maintaining a monopoly. Isabel Lee on this one. Hey, Isabel.
Hey, John. So this all began when the DOJ accused Alphabet's search division of unlawfully maintaining a monopoly by paying around $10 billion to search engines and mobile devices to make Google basically the default. And to help prove its case, they want to use Nadella. They want to use Microsoft, a $2.3 trillion company, to prove their case. So last week, an executive already testified that it failed to secure a deal to put Bing search app in Apple's products. And Apple signed a deal with Google. So basically, this is really all just to prove that Google is now the monopoly. Microsoft now is kind of up. Actually, it's trading flat, but year to date, it's up around 30% year to date. John.
What a turnaround in the last couple of decades, given that it was Microsoft that used to take all the mud for the same kind of story. Isabel, thank you. The latest there, Microsoft just slightly positive by 0.2%. Turning to industrials, Norfolk Southern disclosing that its recent system outage was related to a vendor product defect, not a cyber attack. Bank of America downgrading the stock to neutral, saying this: we believe this is an increasing risk to future earnings, citing increasing concern about data integrity. Katie has this one. Hey, Katie.
Hey, John. Yeah, it's been a tough couple of days for Norfolk Southern. Late on Friday, of course, the rail company forced to halt operations at the hand of another outage, which impacting its dispatching system, train movements, and terminal operating system. Now, as you mentioned, the outage was ultimately resolved at 1:30 a.m. Eastern on Saturday, but it came just a couple of days after an outage on August 28th. And the bad news, of course, continuing for the rail company today with that Bank of America downgrade from buy to neutral. They also knocked the price target down to $215 from $266. They wrote that the multiple external impacts to the operations is of, quote, increasing concern, and that combined with its data integrity and the suspension in customer moves, Norfolk could see potential share loss to its peers. I'm sure we're going to hear a lot more about that when Norfolk reports its earnings on October 25th. You take a look at the shares today. They're down over 3%. All told, year to date, down almost 23%, John.
Not a great year so far. Katie, thank you. Thanks for the update. Katie Greifeld there. About 5 minutes into the session, equities pulling back by just 0.06% on the S&P. On the Nasdaq, we're positive by, let's call it 0.2%. Let's turn to the consumer. The big focus for Q4. Fears about confidence of US shoppers, denting hopes of a soft landing. The co-CIO of Truist Advisory Services saying this: the triple whammy of higher interest rates, energy prices, and the restart of student loan repayments makes the economy harder to land. Simone Foxman has this one. Hey, Simone.
Hey, John. And to that point on consumer loan payments, we saw at least half a dozen corporate executives at major retailers talking about student loans on earnings calls in the past, say, 6 weeks or so, but none of them able to put an exact figure on how much that could be an impact. Now, we've seen clear signs that the lower income consumer is hurting. We certainly heard that from CarMax, talking about consumers trading down to a different level of car last week. But the big question is whether this bifurcation, this high-end consumer, is also feeling that weakness. Now, last week we did hear some signals that there could be. Costco is talking about discounts on big-ticket discretionary items not generating the sort of demand it had expected. However, shares still trading near their highest since 2022. But some other names certainly under pressure, seeing a pretty difficult quarter. Darden talking about softness among households with incomes above $125,000. They're ordering cheaper alcohol. That turns out to be the case. They're down negative 13%, down 13% since mid-July. JetBlue down 50% since early July after near-term leisure bookings in September were lower than expected, also feeling the impact of those consumer costs. Still, the likes of Carnival saying no decline in onboard spending, still seeing robust demand. And we're certainly seeing consumer discretionary stocks still outperform staples this year. Unclear if that picture reverses as we head into Q4.
Well, last month, discretionary got absolutely hammered. Simone, thank you. Picking up on the airlines, JetBlue down and down hard since the summer. All of them have been. They've had to downgrade the outlook off the back of higher energy prices. Energy today still trading in the 90s. So here's the question from Stuart Kaiser over at Citi. Seatbelt sign on or off? 4 reasons for caution: bond volatility, wages, spending headwinds and a prolonged government shutdown. Contrast that with reasons for optimism, including orderly price action, muted stress metrics, positioning and macro data, plus the one wild card of an upcoming earnings season. Stuart, I'm pleased to say, joined us right now. So Stuart, put it all together. Is seatbelt sign on or off?
Hey, Jonathan, good morning. I might not be getting up to go to the bathroom just this week, but, we do think things are going to, hopefully improve over the next couple of weeks. It'll actually be nice to get economic data this week, to be completely honest with you. If we didn't have ISM and payrolls and then CPI next week, it would have been really hard to drive, kind of without that visibility.
Well, Stuart, one point you've made is this rally has been built on upside surprises. At least this year it has. Stuart, that data, walk us through it. We had Seema Shah of Principal on the programme in the last 30 minutes or so. Stuart, she made the point that she expects the weakness to arrive, but ultimately it will only arrive in early 2024. And we're about to see more resilience in the economic data between now and then. Is that something you anticipate as well?
Yeah, look, that is the big question. I would say, look, if we get data over the course of the next 3 weeks, 3 months, like we've had over the last 3 months, which is, a strong labor market, CPI maybe not as low as you would like it, but still sort of low volatility on a downward trend, then I think, yeah, that's going to be a net positive for equity markets, and we're going to continue to be able to move higher from here. Obviously, bond volatility has been the bogeyman recently, but I would generally agree. Our economists don't have a recession really in the forecast until early next year, so you wouldn't really expect that economic data to be slowing meaningfully, at least in the next couple of months.
I know Andrew Holdenhorst on the economics desk over at Citi. Stuart, you know him well. I know he's looking for that one extra hike in November, looking for a decent payrolls to report this Friday as well. I think he was looking for something like 240,000. Stuart, with that in mind, can you walk us through what you think the current relationship is between rates and certain sectors in the equity market? Because what we've witnessed this year is tech's done pretty well, even with another down year for treasuries, and banks have struggled even with rates pushing higher. Stuart, what is that relationship between sectors and rates?
Yeah, look, it's a great question. I mean, to your point, typically speaking, tech would not have dealt with these higher yields the way that they have. But, I think there was a few things going on in the background there. One is just that positioning and sentiment and valuation were so washed out in tech to begin the year that even the move higher in yields sort of didn't offset that. Plus you had, as you mentioned, very, very positive economic growth surprise going on in the background, really difficult regulatory environment for the banks, and, a deal calendar that's been probably not what people had hoped for. So, I think the rates relationship has kind of been overwhelmed by those kind of more fundamental and positioning drivers on a year-to-date basis. Going forward here, our view is, tech is the area that is the most exposed to this rates volatility. And you've seen that, right? I mean, the last month and 3 months have not been been great for tech performance at all. And given that that's the narrow leadership of the market, it kind of creates a risk to the market overall.
Do you have a reason to believe then, Stuart, that traditional relationship between stocks and bonds can reassert itself, the more intuitive one, that a 60-40 starts to work again?
I mean, traditional, I think, is a little bit subjective. You know, if you look at the relationship between bonds and equities, you know, from the late 90s until COVID, higher nominal yields were positive for PE, right? And that was because you had inflation expectations so well anchored that when yields were rising, it was really a growth impulse that was driving them. I think ultimately, over the medium term, you would expect that relationship to reassert itself because, you know, the Fed is so consumed with keeping market-based inflation expectations anchored. So I think if you're in an environment where inflation expectations are anchored, then that equities can work in a rising yield environment as long as that move in yields is kind of well contained and driven by the right things. You know, the last, call it 4 to 6 weeks, the move higher in yields has not been coming from a good place, right? and I think that's really what's been hurting tech so much.
Stuart, when you say that it's not been coming from a good place, can you identify more specifically what you mean by that?
Yeah, you know, I think at the beginning of the year, yields were moving higher because growth was stronger than expected. Recession risk was being pushed out, and some of those rate cuts were being taken out of the system. So yields were moving higher really because growth was surprising to the upside. You know, I think over the summer, you started to get more concerns with sticky inflation. You know, BOJ kind of raising the top end of their range. Obviously, a lot of Treasury supply on the calendar into next year. And those were viewed as really not positive drivers of yield higher, actually kind of riskier drivers of move higher, of yields higher, and that's why equities have not responded to it as positively as they had from, let's say, January through June.
So tell me how you'd respond to this then, Stuart. This from Bank of America in the last couple of hours. Savita Subramaniam, good friend of this program. Really interesting listen to whenever she comes on a program. She says this: equities can still work in a high rate environment. The S&P 500 returned 15% year over year. I think we're struggling to connect with Stuart Kaiser. He says he's lost audio, guys. Have you got him? Stu, you there? We've lost Stuart. I don't think we're going to be able to reconnect either. Stuart Kaiser there of Citi. Unfortunately, that line is gone. I'm going to share with you that view from Bank of America, regardless, from Savita Subramaniam, saying this: equities can still work in a high rate environment. The S&P 500 returned 15% a year from 85 to 2005, even when real rates were 3.5%. But to put a bow on what Stuart was saying, what matters here is not whether real rates are higher, but why they're higher. And the reason they're higher over the last 2 months or so, in Stuart's words, not for good reasons, not for upside surprises on the economic data. Let's leave that there. About 12 minutes into the session, equities on the S&P 500 look a little something like this on the S&P. We are negative and then positive by just 0.02%. On the Nasdaq, up by about 0.5%. Coming up on this program, tensions continue on the UAW picket line.
The UAW demands now are for far more than wage increases. They include things that represent actually bankruptcy risk for the automakers.
Team coverage up next.
Were they ready for 2 weeks? 3 weeks? Were they ready for Shawn Fain? The answer to that is no. They were not ready for the kind of disciplined, focused strategy that the UAW president has brought forward. That's not to say the demands are reasonable, but clearly the leader of this is not the big three, it's the president of the UAW.
Tension simmering between the UAW and Detroit's big three as strikes expand. This time, sparing Stellantis, but putting Ford back under fire over the future of EVs. The CEO accusing the union of bringing negotiations to a halt.
What's really frustrating is that I believe we could have reached a compromise on pay and benefits, but so far the UAW is holding the deal hostage over battery plants. Keep in mind, these battery plants don't exist yet.
UAW President Shawn Fain pushing back right in this. I don't know why Jim Farley is lying about the state of negotiations. We gave Ford a comprehensive proposal and still haven't heard back. Let's get to your team coverage. Mike McKee back alongside us with Anne-Marie in Washington, D.C. AMH, what's the latest?
Well, the latest, Jonathan, is you see that tension between Ford and the UAW. And part of that, what Jim Farley is saying, it has to do with the future of the EV transition. And will those union workers be part of it? A lot of these battery plants, Jonathan, are joint ventures with Asian companies. This is the underlying problem you see with how the Biden administration is really trying to walk a fine line when it comes to these strikes. It's not just that Biden went to the picket line. And, of course, he voiced his support for labor unions. He wants to be the pro-labor union president in history, but he also is behind that federal funding that's being doled out for electric vehicle transition. And he has courted these executives throughout the past 2 years to make sure they were on board with this EV transition. And that is the bedrock of a lot of tension you are seeing between UAW and the big three.
That's the needle the president has to thread. Mike McKee, I think I've been wondering, others have as well, when we start to see this show up in some of the economic data, are you expecting that in any way, shape or form?
We will see it, and maybe we'll start to see it this month in perhaps consumer spending. It'll hit Michigan first. It will not show up in the jobs report this Friday because the jobs report strike numbers are already out. And we know there were 17,700 people who were on strike, according to the BLS, in the month of September. That does not include auto workers. And oddly enough, it does include the striking screenwriters. So the true number is lower than that now because that has been settled. We might start to see it next month, however. The deal is with the BLS, you have to be off work and not paid for any of the pay period that includes the 12th of the month. And this strike started on the 15th. The 12th was earlier that same week. So there was no reason for them to be off the payrolls. They did get paid for part of that time, so it doesn't show up in the government data. Looking ahead, though, there are reasons to think that there could be problems ahead in the data. Furloughed workers at struck plants can get jobless benefits. If you're on strike, you can't. But if you are furloughed because others are on strike, you can. The strike would have to last till October 14th to affect this next month's payrolls. Labor Department estimates there are 4 workers supporting every auto job. So Bloomberg Economics estimates that if all 150,000 in the UAW go on strike, that would mean 700,000 jobs would be at least temporarily suspended in the United States. But that's still a long way down the road. We're only at 25,000 strikers at the moment.
Mike, we'll hear from tens of Fed speakers today through the week. Today alone, Powell, Harker, Williams, Mester. When we hear from those Fed speakers, Mike, when you speak to them about the state of the labour market, do they see this as a one-off, something unique, or do they take a broader signal away from this current tension?
Well, at the moment, they are thinking and hoping it's going to be unique, that it is going to be a one-time bump, and then it will not trigger a wage price spiral. But, of course, we don't know what the situation is with the companies that have to respond to this, especially the United Auto Workers. And then there's healthcare workers in Pennsylvania who are talking about going out on strike. What do the companies do once these are settled and the raises are big? Do they raise prices again? Does that set off a whole new round?
Difficult questions at the moment, Mike, that we can't answer. Mike, AMH, to the two of you, thank you. A bit of data this morning. Look out for Mike McKee with Alex Steele and Guy Johnson in about 9 minutes' time. We'll get the ISM manufacturing number, and then it's on to payrolls Friday with the ADP and jobless claims in between. All of that coming up. If you want a sneak peek of payrolls, the payrolls estimate at the moment, and I can bring it to you, the payrolls estimate at the moment is 168,000. The previous number, 187. That number can move, of course. I mentioned that Citi's Andrew Hollenhorst was looking for something like 240k. He's also looking for unemployment to fall back. The estimate at the moment is unemployment does fall back from 3.8% to 3.7. That's a story for later this week. Let's get you some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Well, the sector action this morning is really, really interesting. The S&P 500 overall, as you know, down slightly, but we have huge moves beneath the surface. To the upside, we have communication services up 1%, helped out by lots of the big mega cap tech companies such as Alphabet, Meta, Netflix. We also have technology up almost 1%, real estate slightly higher. And then to the downside, there are actually 4 sectors down about 1% or more, including utilities, energy, and materials. Actually, 3, I should say. So again, wide variance. It's going to be interesting to see how this day plays out. And of course, on the year, communication services today higher. It was one of 2 sectors higher in that difficult third quarter. It's the best sector on the year, John, along with the other big cap tech names, or sectors, I should say. Right now, communication services up more than 40% on the year.
Abby, thank you. State of play right now. That's the sector price action. Broader market pulling back about 0.2% on the S&P. On the Nasdaq, slightly further. firmer by 0.3. Even with this move in the bond market, 2-year up by about 6 or 7 basis points, back through 5.1%, 10-year up about 6 or 7 basis points, back through 460 at about 464. Further out along the curve, go to the 30-year, 474 right now, up about 4 basis points on the session, and your dollar a whole lot stronger. Coming up, the week ahead, your trading diary, up next. Coming into Q4, coming off the back of the worst quarter of the year, the worst month of the year, and the longest weekly losing streak of the year as well on the S&P 500. 4 weeks of this. Can we avoid week 5? On the S&P, we start Q4 in this trading week by pulling back just 0.1% on the S&P, and the sell-off in the Treasury market resumes. Yields up across the curve by something like 4 to 6 basis points, up by about 6 at the front end on a 2-year to about 5.1%, on a 10-year up about 6 basis points to 463.50. That's the price action. Let's get to the trading diary. We shape up as follows for the week ahead. Your week ahead looks like this. Chairman Powell speaks at 11 a.m. alongside Philadelphia Fed President Patrick Harker, head of Williams and Mester later on today. Tuesday, job openings, the JOLTS report. Wednesday, ADP private payrolls and US PMI data. Thursday, another round of jobless claims. And on Friday, it's the big one, drum roll. It's the data we thought maybe we won't get if we had a government shutdown. We've just about avoided that government shutdown for now. It's the data we will get this Friday. It's the payrolls report just around the corner. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. As always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.